What's up, people? Welcome back to the channel. It's your boy, the King's Crown Academy, and today is December 5th, and we just started the December lockdown mentorship. All right, so today I'm gonna be looking at understanding liquidity and real narratives. All right, now if you're joining this lecture from anywhere around the world, just feel free. It's a free mentorship. Class. I'm gonna be holding this for like straight 2 weeks. All right. So in case you're joining from any part of the world, just sit back, relax, and get your jotter, get your the writing materials, and then let's lock in. All right. So today we're gonna be discussing understanding liquidity and real narratives. All right. So that's the episode one, and we're gonna be looking at what liquidity really means. Okay, a lot of you have been hearing about liquidity. A lot of retail traders know about liquidity. Okay, so but then let's break down what liquidity really means. Okay, liquidity is simply where orders are resting, and it is where the market needs to go fill big positions. All right, more like buy stops, sell stops, limit orders, inefficiencies. Most retail traders think liquidity is a trap, but to institution, liquidity is actually a fuel. All right. So think of it like a car. All right. If you're traveling from point A to point B, you're going to run a particular distance. Okay. So the longer the journey, the longer the distance. And if you're using a vehicle, you have to get fuel at intervals. You have to stop at some point and get to recharge your car so that it can be able to function. That is exactly what liquidity means to the big institutions, to smart money. Okay, so that's why you see your chart price moves ups and down. It moves to a particular point and something happens, it changes direction, it head to the next point. All right, and after some particular stuffs, it's going to move to another direction. Okay, so liquidity is what fuels that. All right, now where does liquidity sit? Liquidity normally hides around previous highs, previous lows, equal highs, equal lows, trend line touches, fair value gap, imbalances, supply and demand edges, and also around psychological levels, all right, around round numbers on the charts, okay? Liquidity also rests around section opens, okay? For instance, London open, New York open, Asian high, Asian lows, you know, these are potential liquidity targets. All right. In short, anywhere retail traders stack orders, that is where liquidity lies. So know this today and know peace. Anywhere liquidity lies, that is where anywhere retail traders stack orders, that's where liquidity lies. Okay, so just get that written down somewhere. Okay, now let's look at the example. Okay, on this example, right, so this is just a picture representation of what I just explained. Okay, on this example you can see above this high, this is buy side. All right, below this low, this is sell side liquidity. Okay, so look at what I'm trying to explain about fuel. Okay, let's say the price trapped buyers here, all right, and headed for this buy side liquidity. Immediately it absorbed this liquidity, it trapped sellers also. Okay, it now came down and also grabbed the liquidity it created before now heading for a proper expansion. Okay, so this is why liquidity is very important. Okay, now this lecture, as I'm explaining this, you're going to be understanding how you use this concept of liquidity as a trading strategy. Okay, if all you trade is liquidity in this market, you're going to be a profitable trader, because that's exactly how smart money sees the market. They operate based on liquidity. Where is the best liquidity sitting right now? All right, that is the first question every retail trader should ask themselves. Where is the liquidity standing right now? Okay, so and that is why this lecture is so important. Okay, sometimes when you come to the chart, you will see price trying to run a particular distance, but it cannot happen immediately. All right, so it might take like a week to cover up that distance. Why? Because of liquidity. All right, it's going to be generating liquidity both to buy side and both to the sell side. And there's this uh, institute in charge of price delivery, and that is IBDA. If you not hear about IBDA, IBDA is like the enterprise delivery algorithm. Okay, so they are the ones in charge of how price is being delivered, okay, across both buyers and sellers. All right, so that is why anytime you come to the chart, if you see a buy or you see a sell, you are right. But depending on the timing, you are applying that narrative. That's what makes the difference. Okay. So yeah, buy side liquidity and sell side liquidity. Okay. Now observe and react. Observe and react. Okay. So let's go. Now, two types of liquidity. We have the resting liquidity and we have inducement liquidity. And that's the fake push traps for traders. All right. So quickly, what I just showed you now, let me go. This is a resting liquidity because this liquidity is resting here as a buy side liquidity, and we saw this liquidity resting here as a sell side liquidity. Okay. So in this type of liquidity scenario, price often just run through maybe the highs or the low, but whichever one it attack first, you will not know if you're going to trade the opposite direction. Okay, so this is a 4 hour chart right now. Okay, you can see as price run into the highs first before running into the low. So if you want this chart when it ran through the highs, you might as well zoom into the lower time frame because this 4 hours, you can go to 15 minutes time frame and catch this sell. All right, but if you came to the chart when it absorbed this sell side, okay, you probably be queuing up for maybe the alternative buy side liquidity. Okay, so that's that. So we have buy stop, which is above the highs, and sell stop, which is above the low. Okay, trend line liquidities, breakout, double tops, first break, support and resistance bounces, manipulations before real move. All these are inducement liquidity. Okay, all these are inducement liquidity. This type of liquidity, you spot them on the chart easily because it comes out every day. So liquidity is not random. Liquidity is engineered. Is often generated. Okay, it's not random. All right. So let's go further. Now, how smart money uses liquidity. Okay, how smart money uses liquidity. Well, and just for clarification's sake, a broker doesn't hunt your stop loss. Big money does, and big money in this case is the smart money. All right, so some of you that keep reporting that this broker is bad or this broker is bad, yeah, in some cases maybe in terms of spreads and some other things, yeah, but please, your broker is not responsible for you being stopped out. Okay, the big money, the smart money, yeah, these are the people responsible for that. Okay, now market makers don't care about your $50 stop loss. Big institutions, banks, and liquidity providers needs millions in order to execute. Okay, they hunt liquidity zones to get these volumes they need. Okay, unfortunately, that's the market we are in. All right, so they don't really care about the retail traders. Okay, the market is for them. They move the market. Okay, so when they are moving the market, those your $1,000 stop loss, $100 stop loss, $200 stop loss, it is not their bone of contention. All right, so that's why they can easily just run through your stop loss like it's nothing. Okay, so retail traders should know this and know peace. Okay, so why price sweeps before moving? Well, have you ever noticed that price hits your stop loss perfectly and then goes to the opposite direction? Yes, it's not because the trade was wrong, it's just an order flow. It's an institutional order flow that takes place. Okay, so sometimes price reaches liquidity to either remove the weak hands, fill institutional blocks, all right, trigger pending orders, okay, create displacement and start the real narratives. So this is why price moves. All right, price sweeps before moving. Okay, now to the big money, liquidity equals destination. Price gravitates towards pockets of orders like a magnet. All right, I have seen a scenario that price headed for a weekly high. Okay, but it cannot complete that move within 2 days. So it's going to be engineering liquidity gradually until it hits the main target. Do you understand? So that's what we mean by when price gravitate towards a particular liquidity zone like a magnet. Okay, I'm going to be showing you on the chart. Okay, now look at this. Now, in this example right now, this buy side and sell side liquidity, price first ran through the buy side liquidity, purged the liquidity here, and reversed. Okay, to grab the sell side liquidity as a fuel to now start the main move, which is the distribution. Okay, so in this scenario now, you notice that at some point they trapped the sellers and then they trapped the buyers. Both of them were trapped. Now, this is how smart money works. They're going to move the market around and confuse you to take action. All right. So, whatever you do, they are always right. Do you understand? So, that's the example here. All right. So, you have to watch out for it. This is it. They trigger you, trigger your pending orders, create displacement, and start the real moves. And that's the example right here. A purge up, all right, a purge down, and then the real move started. Okay. So, let's go further. The real market narrative. Now, market narrative has three phases. Every major move starts after a completion of three stages: accumulation, manipulation, distribution. I'm going to be saying this over and over again. AMD: accumulation, manipulation, distribution. Okay. During accumulation, price often stage in a range. All right. It creates like maybe a heap of liquidity, maybe like building like a buy and sell, buy and sell, buy and sell, and then it's going to confuse you at the end of the day and maybe manipulate you with a fake move towards a wrong direction. And then once you fall in, boom, it moves to the main direction. In fact, even in football, all right, I was trying to explain in my community, right? So even in football, right, when a striker approach a defender, it's just like that. Okay, you first lure the defender and maybe show some skills to maybe confuse the defender to not know your next move, and then that is when you strike. That is exactly what this market does with retail traders. All right. So yeah, accumulation, price stays within a range. Manipulation, that's the fake move to sweep liquidity, and then the real move, which is distribution. So retail traders most times only see the candlesticks, all right, but you must learn to see the story behind the candles. That is building narratives. All right, building narratives. Okay, now narrative example: imagine if ZAU is consolidating. When that consolidation is happening, you'll be seeing equal highs. Sometimes you'll be seeing equal highs and equal lows, which means these are liquidity being generated both to buy side, sell side, buy side, sell side. And all of a sudden, you will see market runs through either the highs, manipulates, all right, and then the real moves drop down into higher time frame imbalances and taps a demand, fills the big order, and then takes out the low. All right, that's the full sequence of this narrative on this example. But let me show you on the chart. Look at this. Now, this is an example of my ZAU chart. Okay. Now, you can agree with me that during this point, price was consolidating. All right. Price was creating equal highs, equal lows, equal highs, and almost equal lows here. So let me say this is a phase, this is a 4-hour chart. Okay. So this is an accumulation phase right now. Okay. Now, what happened? Price finally ran through the highs. All right. And that was the first manipulation to trap early buyers. All right. That was the first manipulation. So after the first manipulation, we saw a displacement. And this displacement gave us a break of structure. All right. But then this is the first manipulation, manipulation down before the distribution, which completes the accumulation, manipulation, distribution phase, which makes the real narrative of the market. Okay, so sometimes when you come to your chart and you see an accumulation phase, maybe on a higher time frame, 4 hour or daily, or let's say a 1 hour, as a day trader, you can just maybe mark the highs and lows and then pause. All right, and then pause. But once you come to the chart and you see that maybe your accumulation phase is already swept, just know that you might be getting ready for a distribution phase. Okay. And that's the point you have to look properly before you strike. Okay. Now, going further, how to read the narrative. Ask yourself three questions. Eh? Where is the liquidity forming? Who needs to be liquidated? Buyers or sellers? What direction will engineer this liquidity before the real move? These are the key questions you need to ask yourself. That's how you build narrative. Narrative is everything. That's why when you come to the chart, sometimes I might be seeing buy, you might be seeing sell, but your narrative is what makes the difference. So we are not here to claim who is right or wrong. The execution's result will tell you whether you are right or wrong. So that's one thing I love about Forex. Okay, it doesn't matter who's right or wrong. Once you execute, you will know. Do you understand? But this is how you build narrative for yourself. Ask yourself, where is the liquidity forming? Who needs to be liquidated? Buyers or sellers? What direction would be engineered before the real move starts? That's how you build narrative as a trader. Okay. Now, let me go. How to trade using liquidity. Step one, identify the targets. I told you once you come to your chart, you mark key areas. All right. You mark previous day highs and low. You mark your section open. You mark your Asian high and low. You mark your trend line touches, your equal lows. Look for imbalance zone. These are potential targets that smart money uses as liquidity. Okay, so they often, know that retail traders might heap some stop orders around those zones. Do you understand? So once you come to your chart, look out for these sensitive areas: previous day high and low, Asian high and low, section open, imbalance zone, trend line touches, equal highs and low. This tells you where the market might go next. Okay, now you read the inducement. Inducement shows the first move. Okay, stop run, trade line fake out, liquidity grab, premature breakout, breaker block sweep. Okay, this market must induce before it deliver. So once you can be able to spot where the next inducement is, you can be able to tell the right direction of the market. Okay, now the third step is to look for displacement. Okay, now displacement often comes after a sweep. You look for a strong momentum candle, a fair value gap, break of structure, a clear shift, all right, and a rejection block. Now this is the confirmation for the real move. Let's go to a real chart. Okay, now you see this completes the circle. You can see that here we have an accumulation phase here. This like an inducement. Okay, now price induced sellers here, all right, and swept this liquidity, and then price caused a break of structure, which gives us a displacement, leaving a fair value gap around here. Okay, this displacement is what we are interested in. Did the displacement give us a break of structure? Yes, it gave us a break of structure. Did it give us a fair value gap? Yes, it gave us a fair value gap. Did it give us a rejection block or another block? Yes. Was there an inducement before that displacement? Yes, there's an inducement. Now this complete this five confirmation: a strong momentum candle, a fair value gap, a break of structure, a rejection block, all right, and a clear shift. Once you look out for these five things and you see it happens, all right, this confirms that, okay, the train is ready to take off, all right, your setup is ripe. Okay, now once you see this, prepare for execution. Execution is, now I have built my narrative. Now I have seen reasons why I should engage on this trade. All right. And now the trade is set for me to execute. Now look for a fair value gap return, look for a breaker block, look for other block retest, look for mitigation block, you look for institutional candle. All right, then you look for those open prices. If price come near those areas within that particular setup, then you can know where you can put your stop loss. But your stop loss must be placed in a zone where the narrative is invalid and not some random line. Please take note of this particular point in placing your stop loss. All right, your stop loss must be on a particular zone, all right, not just based on random line. This is often the mistake retail traders make most times. Okay, now having said that, I'm going to show you a chart example of that. Okay, now after this inducement, we have the displacement, and then the displacement gave us a break of structure, which confirms the fourth point. And then you have a fair value gap, which is the third point. We have a rejection block. All right, everything is already complete. Now we have a pullback into the rejection block. The first pullback came to the first value gap. All right, and then it induced again. All right, it's going to induce early buyers here, all right, and then come back for another stop on. We did not go below the rejection block, and after that, distribution phase started. Okay, so now that's what I'm explaining here. Before you execute, look for a return into a fair value gap, or a return into a breaker block, or a return into an institutional block, all right, or near an open price area. Okay, but in this case, it came back to a rejection block. it came back to a fair value gap around here, and that's how we caught this particular trade. All right, so you can look at this example and you can be able to like know that, okay, if I'm building my setup around this narrative, these are the key criteria I need to look out for before I take my trade. All right, now uh, I don't want to make this video too lengthy, all right, because this is actually the first part of this mentorship. All right, it's the lockdown mentorship coming from the King's Crown Academy, and it's your boy, the Executioner Effect. But quickly, before I go, I'm gonna give you the part 5 of this particular lecture. Okay, so you go back, you practice this. Okay, try and apply it and see how it works for you. Liquidity plus narrative. Now this is how you use liquidity plus narrative as and build a setup. For example, if you are trading London Open, if you're trading London Open, okay, now what you need to do is, first step, come mark your Asian highs. All right, either your equal highs or equal lows of Asian. All right, now wait for London to sweep either the Asian high or the Asian low. Once you come to the chart, wait for price to sweep either the Asian high or the Asian low. Create a large displacement, and that displacement must cause it a break of structure. All right. Sometimes it might not cause it though, but it might give you a change of character. But confirm that, okay, this particular Asian highs and Asian low is being swept by London market. Okay. So once you see that displacement, look for fair value gap. You must have to see a fair value gap. All right. Now wait for price to come back to that fair value gap. Now that's where you take your entry. Most times when you see this kind of protraction, New York often continues the push. Now, this is one strategy for London traders. All right. Now, I'm going to give you the setup for New York traders. So, New York traders that are watching this video right now, if you go to your chart, all right, let London create a trend line. All right. Mark your trend line with the London market, maybe on 30 minutes or 1 hour or 15 minutes. Just look for the two zones or two confirmed touches of those trend lines, or mark out the zone. Wait for New York to sweep any of the trend line. All right. Once you see that, okay, and you see that it creates an inducement, wait for the sweep on both sides, and there you go. That's where the real trend begins. Okay. So this is a particular approach. I want you guys to go, you try this, all right, on your chart, back test it. Don't just learn, go and back test. All right, don't just learn, go and back test. Once you try this, you can pop up on the comment section, tell me if it worked for you. All right, then I'm gonna be see you guys in my next class. In conclusion, liquidity is not your enemy, right? It's just like a map, knowing where you're going, the direction of the market. Okay, so liquidity is not your enemy. The real narrative is the GPS that tells you where price is actually heading to. So that's what liquidity does. It tells you where price is actually heading to. So when you master these two, your result is going to change. Okay, so I'm going to see you in my next class. Welcome to the locked in December mentorship. Okay, now what I need you to do is you're going to master this. Mark out liquidity zones. All the liquidity zones you see on your chart, mark them out. All right, identify the fake move. Identify the fake move, then identify the real move. Journal it. Backtest this for like 30 pairs if you can, all right, or more, and then we'll see. Then if you want to get this particular course, all right, if you want to get this, is a crash course, right? So if you want to get this crash course, okay, click on the link on my bio. It's going to take you straight to where you're going to get this. Is up on Selar.com. All right, we're still here to put it on different platforms for you guys to have access to it. All right, or you can just send a DM and you're gonna get this particular crash course. It's actually a whole new course series, okay, and it's up on Seller. You can just go there, you purchase it, okay. But for now, see you guys in my next class. Remain your boy, the Executioner FX. Make sure you follow, like, and subscribe. Okay, you can always like and share this video. Okay, I'll see you guys on my next class. Peace out.